All right, so our session today is going to be on how to navigate financial planning with digital assets. With me today, we have Daniel, Eric, Cameron. I'm just going to open this up for brief introductions of everyone here. And just to get started, my name is Rustin. I'm the CEO and co-founder of Coast. We are a financial navigation platform designed for digital asset investors. I studied finance in college, worked in primarily corporate environments for a few years, got into startups a number of years ago, and have been working in the digital asset space full-time for 2 or 3 years now. Joining me today as co-host is Dan. I'll let him introduce himself real quick.
Hey, everyone. Thanks so much for the time today. We're really excited to jump into all these awesome topics. Yeah, my name is Dan Durning. I am the co-founder of Coast as well. I come from the social sciences background as well as risk management in big law. I've been in startups for several years, and Russ and I are building, as he mentioned, the financial navigation platform for digital asset investors. So something near and dear to us is financial planning and how we can incorporate digital assets. And we look forward to diving into this.
Awesome. Eric, you want to introduce yourself as well?
Yeah, of course. Hi, everybody. Eric, aka 0xfiduciary.eth. I'm over at Verde Capital Management. And from a disclosure standpoint, any statements or opinions shared today are my own, do not represent Verde Capital Management or my fellow teammates. So high level, I'm a financial advisor with Verde Capital. We are a boutique advisory firm that manages in excess of 450 million in assets. We're an RIA, or another way to describe it is a registered investment advisor or a fiduciary that works with clients in their best interests. Our mission is to put money in tokens, or in essence, to tie them to life fulfillment. And we do this by educating people about their money, guiding them to make more informed decisions, and helping them grow in all aspects of life.
Do you have to do that disclosure every time you speak, Eric?
Every single time.
Okay. just
every time.
Every time.
Makes sense. Cameron, you're up.
Hello, my name is Cameron Browne. I'm a partner at Durning Advisors. It's a Web3 crypto blockchain focused tax and advisory practice that works with individuals, startups, founders, DAOs, all things kit and caboodle. Not only did I do my get my BBA in finance for my 150 hours for CPA, but I actually enjoy finance. Spent some time in fintech on the Reg A, Reg D, Reg CF sides, and which led me down the path of decentralized finance and this chat here today. Thanks for having me on, guys.
Super excited to be on stage with you guys today. It's been incredible chatting with both of you off camera. And yeah, really looking forward to today's session. Today, just for everyone's understanding, we have 4 key objectives that you'll be learning from this session. You'll learn strategies for effectively engaging new clients and educating them on the essentials of digital assets. You'll be able to master techniques to assist clients in making informed decisions about digital asset allocations. You'll learn skills to guide discussions around the choice between self-custodial and custodial wallets, highlighting the advantages and considerations of each option. And then finally, we'll learn strategies for identifying and understanding common pitfalls for financial planning with digital assets. And this just breaks down each. We have them in 4 key categories. The first being digital asset essentials, digital asset allocations. And these are just the 4 objectives that I just read. Self-custody versus custodial assets. And then lastly, identifying common planning pitfalls. So on this first topic of clients and education, or digital asset essentials, there are vastly different types of clients that you'll work with. Not everyone has expertise or understanding of on-chain, off-chain assets, the differentiations of those. And most people don't, I guess most people really just have a broad understanding of digital assets. Maybe they've heard of Bitcoin and Ethereum. Maybe they know of the ETFs that just launched. There's been a lot of publicity around that. So this first question is really around, like, how do you meet clients where they are in their digital asset journey? Just coming from different perspectives. Eric, I want to start with you. How do you really approach this?
Yeah, a good question. The reality is every client, and in essence, has a very different speed. Everyone's at a different wavelength. So because of that knowledge gap, I would say it's a constant question about that overall understanding within the space. Also, we look at things like their overall potential interests, which can range, and also elaborating on how it could be not only revolutionary technology and what that advancement could look like, but also how it can be the wave of unique diversification benefits for a portfolio. So it's really harnessing within a conversation the ability of understanding where someone's at in that trajectory and then making it very personalized.
What about you, Cameron? So you specialize in accounting for digital asset owners. Can you maybe speak to some of the stages that you see clients approaching you? Like, are they primarily very new to the digital asset space? Do you cater to people who have been in it for a longer period of time? How do you really approach this?
Yeah, I see the full spectrum. I would say we have quite a few clients that, spent time working at the FANGs, got their job in a crypto startup. This might be their first time doing contracting work. They might have the first time a token allotment. And this is the first time that they're kind of outside the initial realm of stock options, et cetera, or something that's, through their employer. Also range to people that are, I'd say, full Web3 degen native, where, they're 100% invested into crypto, getting paid in crypto, their assets are in crypto. And we spend quite a bit of time helping the adults. Sometimes I'm partnered with Eric and other FAs to help them understand that it's okay to own the S&P and try to balance and bring some more diversification in their overall asset base.
What kinds of questions do you typically receive from your clients? Like, I assume that since you service a broad variety of people coming from different perspectives, maybe someone owns primarily the S&P and they're interested in this new asset class. How do you really support their educational needs throughout the process of working with you?
Yeah, I would say from the earlier tranche too. So like this might be exposure to crypto. They might have a MetaMask wallet doing some swaps. Help them understand some of their applications of trades, or hey, I'm going to go get something that's crazy as interacting with Aave and generate a loan, or I'm going to go participate in a liquidity protocol like Uniswap. They sound, pretty blasé for people that have been in the space for quite some time, but also can be really new and kind of scary at times, the tax impacts. So just helping them walk through, understand where certain pitfalls may be, the implications of those transactions. And also on the flip side, we deal with a lot of people that, get compensated within cryptocurrency. They may get, token options, restricted tokens. They may be staking their restricted tokens, and helping them understand, along the way, and where we could file an 83B to help them, manage the tax implications of their portfolio.
I love that. And I love that you're speaking to some of the more in-depth components too, right? Like staking is a very different thought process than a traditional investing environment. And so from that perspective, when you, Eric, have clients coming to you who maybe are staking assets or they're interested in borrowing, lending on some of these DeFi protocols, I guess what's your stance on helping to educate people and guide them in the right direction?
Yeah, no, great question. I'll give a little bit of a different take on it. As with Cameron, we're seeing people that are working on specific projects, getting paid in crypto, and then also have massive windfalls where they're getting either massive airdrops or they're getting liquidity opened up. Very complicated, but that's one very big difference within the space. I would say most of it is more so when we look at an acknowledgement understanding of where they're at in this journey. I'm finding that most are still at that point of trying to break down some of these basics. So we started the conversation really about the internet and its progression. It sounds very basic, but for me, it's not like I started with crypto native individuals at the onset. It was the average person that sort of came to us in some form in their 20s, 30s, 60s, and wanted to talk about different goals. So high level, we talk about the progression of the internet from reading to writing to owning it, sort of like Yahoo to Facebook to now Web3. We tie in the environment and sort of reasoning for blockchain tech and Bitcoin. So why did that even come about during the credit crisis, like that backstory? We then tie it into comparisons with Bitcoin relative to things like the dollar or gold, because most people can start to understand, oh, wow, this is some form of currency or something I could use for transactions. Oh, wow, this has a limited or specific quantity. And it allows people's minds to actually get wrapped around it. From there, we highlight the extent of what can be built on blockchain tech, and that's the exciting part. So not just what can be built, but the reasoning for why that can happen and why that's revolutionary. So that's when we started to talk about things like Ethereum being the most obvious, but ecosystems or chains, and then obviously protocols that could be built on top of that. And how I try to sum it up is looking at chains sort of like planets within a universe. And then also looking at protocols as, let's say, states within that planet. If you frame it in that form, most people, if you are 5 years old or 50 years old, I think can understand it.
That's a really interesting framing. And I think it just highlights just how unique this space is and how very broad it is. Like within digital assets, there are all kinds of assets that someone can acquire and they might be used for different types of utility. How do you really approach allocation from a individual perspective of their portfolio? Like, would you recommend doing borrowing and lending for someone who is fairly new to crypto? Like, what does that trajectory really look like for you, and how do you approach allocations?
This is a massive topic, so I'll try to I'll try to sum up some of my thoughts on it, and then allow Cameron to jump in. So I believe that all clients should have some aspect of their portfolio in digital assets. So perspective, we believe that everyone in some form should have it. So even in advance of them showing some form of interest in adding assets, we already acknowledge this in every meeting that we actually have. So that's food for thought. This comes up in every client interaction. All that said, it is about understanding those goals and those priorities. And I'll keep coming back to this. Everyone's goals and priorities are really the starting point of where we go from there. So more specifically, it's about having a conversation about how this fits in to that overall plan for themselves individually, maybe for their family, their spouse, their children. That's really where you start to uncover more of what is the appropriate allocation in whatever form. When it comes to allocations and getting started, I do think it's appropriate to start with the largest and most notable tokens. Those are the ones that have the most staying power. Those are the titans of the space. So we start with Bitcoin and Ethereum. I feel it as though when you're looking at the space, those are the starting building blocks. From there, we can expand further and talk about different categories from derivative staking, lending, restaking, et cetera. The same applies to means for getting exposure, right? So we haven't talked as much about that, but high level, many different ways to get exposure. Different clients have different needs. For the certain client who I have who is 55 or 60 years old, who has never been exposed to this, it is an ETF that maybe makes the most logical sense. It's simple, it's streamlined, it's at a high level cost effective, and we can rebalance it efficiently. For more direct exposure, we can go through firms like an Eaglebrook, where again, we're unpacking a lot, but being able to go through a solution that offers crypto exposure, even separately managed accounts, but does that through, let's say, like a Gemini, where I'm getting closer to the actual token. And I'm doing it through institutional cold storage, but that's a different type of client that would even be exposed to that. And then even more directly, at another extreme, what I prefer personally, and I think what all of us on this call may prefer, but is not typical for everyone, is self-custody. So being able to actually receive on-chain recommendations. And one of the preferences has been L1 advisors, where you can still be self-sovereign. You can still get advice and guidance from a Cameron or an Eric or an estate planning attorney. But as you're getting those recommendations, you actually, as the client, make the final decision on accepting that transaction. That's pretty incredible. And that is at the core ethos of the space, why I fell in love with it. But that is not for everybody. That is still quite complicated. So as of now, the overall market cap is very much skewed to Bitcoin, but my preference is to not ignore that number 2 with Ethereum. So when we look at overall exposure, even though right now, I think broadly it's like 75% to 25% for Bitcoin versus ETH, I want more in Ethereum. So right now, giving specific suggestions, 65% of our allocations are Bitcoin, 35% is Ethereum, because that's the starting base layer. From there, different clients have different needs, but if you have the more traditional client, this is a good starting point depending on the risk. And we start at 1 to 3% of their portfolio being allocated to crypto with at least 100% drift, What does all this mean? It means that, well, people have different risks. So it's 1 to 3% is a good starting point, depending on risk. It's a small sliver, yes, but it's a starting point. And then from there, we need to rebalance things. That's one of the most effective tools with portfolio management that is really not as understood. And we let things drift up to 100%, if not more. So someone could potentially have up to 6%, if not more, depending on us going beyond the algorithms to say, hey, we're in a bull market. We want to allow that to move even more. So almost done for our clients who come to us with large allocations of crypto. So thinking of a very different conversation, someone who's more of like the whale within the space, or someone who's getting paid from a protocol with tokens. It's about making sure that their goals for the future are aligned properly and funded. Seems boring, but it's effective. There are more parallels with crypto natives with sizable allocations to, I would argue, business owners and even real estate moguls. So that sounds a little crazy and interesting, but when you have this over concentration, it does have to be a risk conversation. And I like being able to go back to the basics of maybe having about a third of your wealth or net worth in real estate, a third of your net worth potentially in more traditional, at times maybe boring assets, but effective, right? S&P or the stock market or bond market, and then having about a third within crypto. Again, that's a broad way to sort of look at it at a high level as a starting point, which is what we do for a lot of business owners that have a lot of real estate or a lot of franchises with some of our clients. I think it could be applied to this space as well. Let me pause there because that was a lot to unpack. If you have any questions, or maybe Cameron wants to jump in.
I love the three-legged stool approach of splitting up assets between multiple categories. And so what I'm hearing is that my 40% portfolio in crypto is probably a little bit skewed, but maybe I'll take this over to Cameron as well. So Eric, you primarily work with your clients on a proactive basis. Cameron, I'm assuming just based on your line of work that you work with clients more on a reactive basis. Maybe they have purchased these assets or they've ballooned over the course of a year with a substantial bull market run. Is there a allocation conversation that you have with your clients, or do you typically punt that to folks like Eric and you navigate the tax implications of that?
No, I definitely don't have the allocation question. I'll punt that to Eric and other more credentialed experts in the space, and L1 Advisors, again, one of our partners and clients, an incredible platform because they get those insights. Essentially, though, like you said, we generally tend to be more reactive as much as we try to be as proactive as possible. So what comes to us, is we're looking at tax loss harvesting, looking at which lots we can harvest. Depend upon which, cost-based methodology. With certain softwares, you can isolate FIFO, carry it over to Opti, Zero, or LIFO, or specification to try to help out, or just, looking at the various activities they're up to. Hey, you're involved in Aave. All right, well, maybe it could be contribute a swap, maybe you're depositing as collateral and generating a loan, but looking at each individual event to see where there could be a taxable event recognized, see where current IRS guidance FAQs could be, and also understand and work with the client's portfolio's risk percentage or risk profile. Trying to get more proactive though is speaking, going back to the 83B, we work with a lot of folks that are contributors in the space. They may be getting token grants, restricted tokens, token options, and far more often than not, I get it's just vested, and it's like, great. Now it's income, or I exercise it. Great, now it's income. There's not much I can do besides calling Eric and saying, all right, what kind of planning opportunities can we put this to work? So it's really great when people come to me saying, hey, I'm getting this, restricted token grant. Okay, we can have a conversation about an 83B. And what's fantastic about an 83B is we can, mark the fair market value of the award as the data is granted. And then whenever it, unlocks or you exercise it, we're not talking about any sort of event until next end the underlying tokens are sold. So really, really great for people that are part of early stage ventures. Maybe there's not liquidity, it hasn't reached mainnet, or even for ones where the project's early and it might be traded on CoinGecko, but it could be doing 50 to 100x the next 2 to 3 years. So that's something that we try to push as much as possible when people come to us, or we try to at least people be aware of it. But unfortunately, more often than not, we're getting young kids that, hey, I got this great grant. It's awesome that you got this nice golden goose, but unfortunately comes with the tax penalty.
Hey, Rustin, I want to add something just very briefly on this. That's, I think, really, really important for everyone to understand. I need to be able to have conversations with other partners on some of the complexities that some of these clients are dealing with, especially some of the crypto natives. Those are the more complex scenarios where there are plenty of conversations that, as an example, on a couple of clients, Cameron and I are having conversations about, where then I also have to bring in estate planning attorneys to talk about, wait, what are we not considering from a trust format? Because we're going to be having X amount of money coming up to where we're going to have, we're talking about situations that are hundreds of thousands, if not millions of dollars that 20 and 30-year-olds are getting access to because of token unlocks. And it's life-changing. It's a massive windfall, is arguably an understatement. And doing that right could be the difference of millions of dollars in either direction. So as we talk about all these things, there's no way that I would say a financial advisor, even a CPA, does any of this alone. It's really being able to quarterback and have all these professionals working in tandem.
I think that's so important because education ties into all of this, right? Like if someone does not understand what is available to them, then they may misallocate or they may sell tokens and incur a huge tax penalty that they are not really prepared for. Or maybe they, sold some of those tokens, bought a Lambo, and now they have 50K in taxes that they have to account for. That's super, super complex. And it's also why I appreciate just, I guess, mentioning that it is very important to have multiple professionals in each client's lives to be able to navigate each area. Like there's no way that, Eric, you could uncover all of the nuances of the tax sector. And Cameron, there's no way that you would be able to navigate like all of the estate planning practices while also trying to figure out how do we optimize this person's or I guess limit their tax implications based on these tokens. And that's really what I'm getting out of this segment a lot, is just to surround yourself with other professionals who are like-minded to really build a team around you and your clients so that you can point them in the right direction should there be a question or a topic that needs a little bit more speciality, I guess.
No, most definitely, Rustin. I mean, Eric and I joke quite often is that we're helping all these people adult. They're getting these, wonderful bounties, and it's like, well, you got to do something with it. You got to think about it. What about the future, kids, house? Like you can't just YOLO it. And the financial expertise and savviness is not there what it used to be. And it's something where you're actually doing some education, some help, and helping people think more than just like, great, I've got this, this wonderful bounties. So yeah, more often now we're like, yeah, we got to help them adult, dude.
For sure. For sure. I love that. I think we're wrapping up on the allocations segment of today's session. I would love to turn it over to Dan to, I guess, cover the self-custody versus custodial asset topic for today's session.
Sure thing. Thanks so much, Rustin. Really enjoying this conversation. Just wanted to double click on a topic that we were all just discussing here. When it comes to finding other professionals in the space, do either of you have any best practices or just ways that you go about finding or sourcing those connections, whether it's attorneys or accountants, so forth? If someone's new to advising clients in this space, what advice would you give them on finding those connections?
I'll go first briefly. A lot of how I have made some of these connections has been diving into Discord, diving into Telegram, and meeting more community members and making friends. Honestly, that's how it's been. And you'd be surprised how many people are willing to communicate with you even on Twitter. That's been hugely impactful to where sometimes it's just DMing someone and you'd be pleasantly surprised that they're more than willing to connect with you. And frankly, these are some of the means that I use to even connect in a way with Cameron and other people over time.
No, I concur with that. It's just good old fashioned door knocking. And I think as far as understanding whether someone is with it and who's not with it, because there's a various degrees of Web3 attorneys. Someone could be focused on tax law, they could be focused on startup law, they could be focused on DAO law, they could be focused here. And just trying to find that right mix of professionals just requires just knocking, having conversations. And, there's, more fiduciaries out there. There's attorneys out there. There's, marketers, there's other service members, there's payroll, there's accounting, there's, accounts receivable. And it's a matter of just finding that right, like, tool in the toolbox, but knowing that you have 3 to 4 attorneys you can call on in this client situation, and they can get a referral. Because the unfortunate part of this space that there's only so many out there. So knowing that there's a couple that you can refer to, at least if they're busy, they can go someplace else, or maybe they don't jive right, the communication, the flow isn't there. But going back to Eric's point, Discord, Telegram, going to in-person events, ETH Denver, Consensus, all there, just button up and showing it. And then, also networking with, some of my best, professional contacts have been through clients. Hey, you should go check out my attorney. Check out this person. And then we have a conversation and see if it gels, and we just go from there. So it's a lot more personal than you think it would be, and it's just a lot of talking.
I love that. And I've definitely been blown away, I think, by just the community within crypto and Web3, and these communities that exist, like you said, on Discord or Telegram or even Twitter, or X, I should say. It really is just amazing to see everyone supporting each other. So really great advice there. I want to shift topics slightly here and dial in on a specific topic here related to self-custody versus centralized exchanges or custodial assets. And sort of, I guess, at the highest level, what is sort of your, what are your, like, the tax implications of self-custody versus, say, centralized exchanges or other custodial methodologies? And how do you sort of navigate that with a client in determining what is the right approach for them? And I'll pass it to Cameron to start.
Yeah, I'll take the first one. So in the case of custodial, like the ETF, I'd say it's quite simple, right? It's traded through an exchange, up, down, capital gain, capital loss. And that's really about what you can do with it. There's no margin lending, there's no liquidity against it. So although it's a lot more simple, you're also with trusted, larger partners, whether it be the NEC, BlackRock, et cetera, which has a lot more, experience and less, I guess, overall financial risk than, smaller platforms, the DeFi space. You lose the opportunity to have more autonomy and therefore usability of your assets. Something that I can personally, I've gone down there, gone down my own path is, I hold staking to liquid staking tokens. I've got RETH, I've got Steve on Ethereum, and, I need liquidity. I can deposit that into Aave. I can generate a loan. I have cash or USDC at that point in time. And I still have my long position, but I actually have liquidity to carry out my day-to-day operations. That's something that's not really afforded to a lot of people in the day-to-day. They can't borrow against their they can borrow the 401k, but traditional IRAs, SEP IRAs, even the brokerage accounts, that sort of liquidity and autonomy just really isn't there, which is something that's beautiful about crypto. It's custodial or self-custody.
And Eric, do you have any insights there on self-custody versus custodial?
Oh man, when you bring up tax implications, I almost want to go back and say, ask
I'll take
Cameron.
it.
When it comes to tax stuff, I am not going to pretend to be the professional in this space. I'm not a CPA, I'm not Cameron. But what I will say is I don't necessarily see a change in tax implications of self-custody versus custodial assets. I think it's, at least for the US, if we're talking US specific, I think it's more about a conversation about involvement and complexity of the record keeping. So I think it's naturally simpler when you receive a tax form from, let's say, a custodial operation or exchange versus having to use maybe separate software or spreadsheets for all the self-custodial side. It's just I think it's a conversation of complexity and involvement by the end person, but also this is why Cameron and all these crypto CPAs have a job. It is complicated. I had a conversation last night about someone who, frankly, because of their role and what they're involved with within the Ethereum network, is getting an obscene amount of airdrops. Good for them, but some that they don't even want. And it brings up these conversations that they don't even know how to unpack. This is why people like Cameron are so useful within this space.
Yeah. No, and back to Eric's point is ETF custodial assets, very, very simple. It's going to come through your 1099B, you take it, drop in your tax return. But as soon as you get involved on one chain or multi-chain or different activities, LPs, vaults, staking, airdrops, yada, yada, yada. These are all various things that requiring you not only is it self-custody, but it's also self-reporting. There's nothing out there you can just plug and play. It's the reason why I've got a job. It's why a lot of the professionals in the space, it's just spend time reconciliation, rolling up our sleeves, importing, exchange accounts, wallet addresses, looking, tracking basis issues. So with all that autonomy and agency you have with your money, or currency, so to speak, with your assets, it comes with, responsibility. And unfortunately, a lot of people will go off the deep end. They'll get these airdrops, they'll do crazy things in DeFi, and then they'll come down the road and we're spending a couple of years of cleanup to get things right. And then you're not being a planner, you're not getting ahead of things, you're being retroactive or reactive as opposed to be proactive. So yeah, that's something I'd say is the shoulda, coulda, would is every situation is just being better in your accounting day to day, which is, I guess, what every accountant can ask for.
I want to double click into something that Eric just mentioned. So you mentioned receiving airdrops and this person not even wanting to receive them. So it's my understanding, and Cameron, I would love your take on this, that whenever an airdrop is received or whenever it's claimed, it's counted as income at the, I guess, dollar value that it's claimed. So then for some airdrops, they just kind of appear in your wallet, right? And it's not an action that you actually take to accept it. That imposes tax implications for people that they may not even be expecting or wanting, to Eric's point. How do you approach that?
We hope it's worthless because it just solves the question. In the case of like dusting or spam. But yeah, I mean, generally though, is if there is value, if it's been just randomly dropped into your wallet, which I guess happens on chains where gas is quite low. Matic, Polygon, Solana. And generally treating those as income that's been accrued to you. You can't just like go, shoot, go away. But in the case of someone's giving you a free airdrop, take advantage of it, claim it, use it, hopefully it's not scammy, and trade it for something that's actually usable. What's, I guess typically on ETH or, in the Cosmos ecosystem, it actually requires claim events or participation or certain steps to get there. I would say the dusting or spam attacks or random airdrops that happened a lot back in 21 and 22 have thankfully subsided across my clients' portfolios. Doesn't mean it doesn't happen. But a lot of times the softwares today, Coinly, Coin Tracking, Coin Tracker will just kind of write them off. They've seen a couple of their users mark them as spam, which thankfully does a lot of the dirty work. But if someone's giving you free money and it's not, a rug or a hack or anything else, it's free money. What's a little bit of tax on free money?
Super insightful. I guess just to sort of follow on to this question, how do you help clients determine like what the right approach for them is? Is it, an interview or part of a larger plan, or, how do you, I guess, navigate conversations related to making a choice like self-custody for their finances?
I think it goes back to the education topic. We keep coming back to this, but because of the range of clients that at least I've been seeing, education's all over the board. I have people who have incredible technical expertise that blow me away, to other people at the other extreme that don't even know what Bitcoin is. So I have to really navigate and traverse a lot of paths. The whole point is it comes back to every conversation is, what are those needs that you're trying to achieve? What specifically are these priorities or goals that you want to actually accomplish? And then also, what are some of your interests? Broadly, personally, but also professionally, and also chain specific. There have been a number of instances, even recently, where someone has said, I have more of a preference for the Cosmos ecosystem or Thor chain versus, let's say, Ethereum. And that is a very different response than I might get from someone else. So it's being able to really ask the right questions so then we can navigate that together. And for me, I think it's beyond intellectually stimulating, being able to dive into this space, right? Which is why I love it. But it frames I would say, how far we need to go down this rabbit hole. And all that said, the biggest conversations of late have been around managing the sale and even timing of crypto assets. Partly because people don't want to miss out on these opportunities to fund these goals, but also they want to capitalize on the windfall. And I will tell you, people are stressed. I have, where I will typically have conversations with clients on a quarterly basis on different key areas of planning, the 6 main drivers. The reality is I had a conversation last week with a crypto native, and I'm going to have another conversation in the next 1 to 2 weeks because of what's happening in this bull market and what's happening specifically to tokens that he is tied to that is having a massive impact on what he can do with being able to get a home and finance that for him and his wife and their child, but then also potentially out of pocket be able to fund education costs outright for private school and college. Interesting combos. Yeah.
Yeah, super interesting. I love thinking too about like practical real world applications of digital assets. And like you said, maybe buying a home or just applying them to traditional purchases that are really important. Are you seeing more of that in general? More folks looking to use their digital assets as collateral or down payments? And are there any sort of tools or mind states that you're sort of communicating to them to help them think about that?
Okay. Yeah. Go ahead.
I was gonna say I'll go short. Yeah, I was like, I've seen a lot of clients that have had this windfall take it and to put into real assets. Buying a home, buying their homestead property and taking that wealth and putting into something that's real and tangible because it's something they've been dreaming for the past 5-10 years on. So I've seen that more often than not. And I don't see people, the doubling down aspect of 2021 has kind of gone away. I see people like they see this windfall and they want to put it to use someplace else or kind of like deleverage or de-risk. But this reminds me too, Eric, because what was that platform we chatted with on the, it was the one that was offering, Bitcoin backed loan or mortgages. Do you remember? I can't recall the name, but there are platforms out there that are offering. They're out of Miami, but I just can't remember the name. Anyhow, I'll let you take it.
I was going to say, I can't remember that name either. There are solutions that are out there, but to Cameron's point, I concur. Like everything that he's saying is actually pretty accurate from the standpoint of you are seeing people who have windfalls and they are not doubling down. They are not saying, oh, let's put more in here. Oh, let's use Liquidity or Aave and lend against those assets. You think that might be happening, but typically it's not. They want to deleverage. They want to be able to have something that gives them more predictability, more comfort, and it might be offboarding it via Coinbase or whoever into their traditional assets where it's more predictable. I've even seen people where they'd prefer to have, for some of their cash reserves, have an FDIC insured account that gives them, let's say 5% versus having 5 or 5.25% through Coinbase on Coinbase's main site. So where we all think that these risks are so heightened with crypto natives, I've actually seen the complete opposite where they're trying to de-risk. Now they still want to hold on to their crypto assets to a degree, but it's being able to figure out the best way to navigate that where it doesn't become such a massive size and then they disproportionately and negatively impact their financial well-being moving forward because they have more at risk now. They have families. It's not just the 20-year-old who's doing this on their own. I've seen that too, and they will keep it all within that token. But I'm seeing people who are more so family dynamics, risk changes.
Yeah, I think that makes so much sense. It's definitely an emerging space, but as you said, like people are already doing this, and I'm really excited actually to see where the innovation comes in on a lot of these topics. Real quick, wanted to switch over to our last topic here, related just to, this is a very dense topic that I'm going to bring up here, and I think it's probably a two-part question, but really just want to get a sense from both of your perspectives on what are some just high-level common pitfalls that you see clients encountering or folks navigating in their own way and maybe need advice on. Just at the highest level, what would you say are some of the biggest pitfalls for financial planning with digital assets? Let's just start there.
High level run through, lacking a clear plan. Most people don't really realize that you need to have a goalpost. If you don't have a goalpost that you're trying to strive for, you're wandering the world aimlessly. Nothing's going to get accomplished. So needing a clear plan, not having emergency funds. It pains me that people don't consider this, but it is literally the building block and the base layer of everything that can be accomplished thereafter. So having emergency funds, I'm seeing people at times neglecting retirement savings. Do not neglect that. The wonder of the world with compounding interest and exponential growth is possible, and 20 and 30-year-olds have the best opportunity to take advantage of that. Not underestimating the importance of insurances or risk management with health or life or disability, which seems boring, but is very necessary if you're a programmer and you only use your hands, right? And something happened to your hand. Lack of diversification with investments is another big pitfall, but we talked about how we're trying to navigate that for people. Understanding risks well enough, even with a lot that's going on with restaking, which is wonderful and unique and creative. Not everyone's talking about some of the risks tied to that or other protocols that are coming up out of left field. Like, take a step back and really know how to assess these risks versus just going for all the points. That's controversial, but let's use it as an obvious that's happening right now. Emotional decision making. Because the market is so volatile and heightened at times, you have a lot of emotions that make you want to run to something. And we're trying to help people realize how to use emotions in the right way. And then I would say, last but not least, needing to have regular reviews and adjust the financial plan. Like with the crypto native, where I'm talking to that person every other week and sometimes even more frequently because of what's happening with their tokens. It's us actually in real time having to constantly evolve, because one week they had $500,000 in a crypto token and it actually just went to $1 million. And we have to figure out what to do in that moment. Very different that you don't see with the traditional client. And then do not overlook estate planning. Like in my case, my wife has no idea what to do with my specific ledgers. You have to build out very specific details for the people who you love if you really want this to be able to be there for maybe more generations and beyond.
Yeah, really appreciate that. I mean, it sounds like there's a lot of pitfalls, quite honestly. It is, and I know this is like a hairy question in the sense that there's any number of, opportunities to make mistakes. And I think this just really speaks to the need for support and the need for advisory services and just people who can help us navigate all of these complexities of assets. I guess going to part two of this question really is how do we help people avoid some of these common pitfalls, and how do we help our clients, or as an advisor, how do we think about avoidance or risk management, to your point, to make sure that we stay on the right track?
I can hop in there. I think a part of it is just education and helping clients think more proactively than retroactively or reactively. More often than not, I think a lot of, the vast majority of Americans go tax time right now, and I'm gonna do my taxes. But the unfortunate part is what we can do after the fact, not much anything besides maybe some set by IRA contributions, HSA, solo 401k potentially. But anything, all the real dirty work happens before 12/31. So going out, chatting with your clients, understanding the events. If they're part of a project, hey, do you have a token allotment? Are you looking to have one? And just trying to get ahead of these certain kind of huge material impacts in their situation, and just understanding, a lot of what they're up to. Are they getting compensated as a contractor? Are they W-2? And just trying to understand where we can, have little like levers in that agency. I could go over to Eric though.
You're basically saying like token risk conversations, right? For the most part, is that right, Dan?
Yeah, exactly.
Yeah, there's a lot to unpack in this, in my opinion, but what I would say is high level, it's looking at setting expectations properly. It's being able to acknowledge market volatility so they understand what they're actually getting themselves into. It's sadly the regulatory risks that are out there and continuing. It's being able to remind people of some of the technology and even security risks, understanding liquidity risks, lack of consumer protections. Again, some of these might sound at times boring, but like these are huge potential risks that no one really acknowledges as well as they need to. Tax implications to, frankly, Cameron's neck of the woods. And then even other technical complexities that are involved. But if we break it down, how I would build out a framework of how you should go through it is absolutely, to Cameron's point, education is everything. It is at the base layer of being able to do this effectively. And you have to be able to communicate with people from a huge range of backgrounds. So information, and doing it with educational materials or having the right resources. I do beautiful AI presentations. That's how I do it. How do you do it? From there, customizing the discussion. So being able to traverse this world and talk with the 60-year-old who doesn't even know what a Bitcoin is, to actually being able to talk to the crypto native who is an amazing engineer or developer on one of the top protocols within one of the ecosystems, using real world examples to break it down, setting those realistic expectations. Always encourage questions, encourage people to dive into the weeds with you on some of this. And then one of the things that still needs to be built out, but I know that L1 has started this, and even some of the things that you guys are working on, I think is going to help this immensely, is being able to do more with like risk tolerance assessments, being able to help people beyond just stocks and bonds, but within crypto, which all looks relatively high risk with the volatility, how to actually have a better risk assessment tool there, which is quite important. And then regular reviews.
All great insights there. Yeah, really appreciate that. I think that topic of education, I keep coming back to that. I know it's been highlighted here a lot. In Rustin and I's building of Coast, we really have identified this as like a critical aspect that's missing in consumer finance, right? Like 75% of Americans don't have a financial plan whatsoever. Never mind how do they incorporate digital assets into an estate plan or into part of their financial plan, but really being aware that it all starts with education. And that's, at a consumer level, giving people resources to learn and educate and ask questions and develop those insights. But I think too, as professionals, like it's great that cryptos and CFOs exist where this community can, consult with one another and learn from one another and really get that education that we all need to be great professionals and great advisors to our clients. So those were all of the CPE questions. I wanted to open it up and see if there are any questions from the audience perhaps, or Rustin, if you wanted to jump in with any other questions that you may have.
We could do QA. I also do have another question queued up if we want to dive into one final one to cap off the session. Maybe I'll start with that question. And if we get some brief questions in chat, then we can refer to that. But the question that I had in mind that I think might be interesting just to discuss here is, what future or emerging trends are you most excited about when it comes to digital asset financial planning? I would love for both of you to cover this one.
It's what I DM'd Eric when the ETF got approved, is financial advisors get to have fun. All the attorneys, the CPAs, we've been having all the fun the past few years, having a conversation. They've been sitting on the sidelines. So the very fact that people get more involved and it's added more legitimacy as a financial advisor, like, hey, you could own Bitcoin through an ETF. Why don't you try own it through an exchange? And then you can say, what about a wallet? So the very fact that's opened up so many doors for FAs, I think it's huge and just adds more legitimacy. So I think for that, I know that's just huge in of itself.
Yeah, so there have been some huge differences over the last number of years, but I would say that is a huge one. It is getting a lot of attention, but seeing options with access, more options with access. So ETFs, that's been huge. That's been game changing. And I still don't think we've seen the full impact of what that will look like. We're seeing massive inflows. I believe it's still just beginning. On-chain wealth management solutions and separately managed accounts is another big deal. And we're also seeing more needs and interests from the public, right? So adoption is very much changing. Even what you're seeing being done with Coinbase, where they have 52+ million people who have crypto in some form or another tied to them, being able to now have this unique ecosystem built on top of optimism with Base, and being able to already put the tools in place to try to bring more people into the world of DeFi and to bring into this next layer. I think that's pretty incredible. And another big thing that I've seen, at least with financial planning broadly, is we have more designations. There's more abilities for advisors and people within our space, even professionals who are on this call who are curious and wanting to dive further. You have the DACFP, which is for financial advisors and other professionals, even clients, if they want to get acclimated. That's tied to Rick Edelman. You have Inner Access that's tied to Adam Blumberg. So really fascinating things that have come out that 5 years didn't exist to the degree that they do now.
I think for me, I kind of want to chime in here too. I think for me, I'm most excited because it feels like we have crossed the chasm and we're maturing as an industry. I really think that the ETF approval, the Bitcoin ETF approval that occurred last month, was probably single-handedly the most important event to happen within the digital asset space since the Bitcoin white paper. Like that is where we got a stamp of approval. There are now a lot of eyes on this industry. There's going to be a lot more interest. I agree with you, Eric. I think money flows are just starting. And so that first 5%, if we look at a bell curve, I guess, of adoption, that first 5% is the hardest to get. And then it precipitously increases from there. And so I think that we have reached that, mark within the industry. And I just get really, really excited about what's to come. Maybe just to wrap up, do we have any questions in the chats to cover? I didn't see anything come through. Any final thoughts from the panelists?
I think there is just one question right now in the chat. I guess there's a question for Cameron. Have you experienced capacity constraints due to the overload of crypto tax work? And do you ever have to turn away clients?
Yeah, I would say, like other tax advisor practices at peak times, or certainly there's capacity constraints. I think it's just the nature of not even crypto itself, but the nature of being a tax practice, and everything gets fit in between February 15th and April 15th. I would say, do we have to turn away clients? We typically do, but if they don't fit within our, software support, not the right vibe, we don't like, their history, or if it just isn't clicking. But if someone, is on a software support, they're from a partner, or we're game to work with them, we're never going to turn them away. So we're excited to have them aboard. We've been a little bit more choosy with who we work with, rather than just taking everybody and anybody. And that just comes down to software, market fit, knowing our portfolio, and working with over 500 folks the past 3 years.
Awesome. Thank you so much. Any other questions? I don't see any others in the chat. Yeah, it looks like Brandon wanted us to mention Coast. Happy to. I'll pass this over to Rustin as well after, but yeah, Coast is this financial navigation platform for digital asset investors. We are currently in closed beta. We have about 100 people using the platform. Would love anyone here, if you're interested in being a beta tester or a beta user, feel free to shoot us an email or go to our website, getcoast.io. We are trying to build a lot of the infrastructure we think is necessary for consumer finance related to digital asset ownership and digital asset investing. We're trying to build out a series of features that really capture the entire life cycle of digital asset management. With that, I'll pass it over to Rustin.
I think you covered everything. And yeah, for some reason, I'm not seeing the questions that were posted. So my apologies there in chat. A little bit of dysfunction on my side, but I think that wraps it up for today. Eric, Cameron, thank you so much for coming and attending this session. It's been a pleasure to chat with you again and to hear from your perspective and the wealth of knowledge that you bring to this community. Really, really appreciate your time. A big shout out to the Crypto CFOs team once again for putting on this conference and for having us be able to do a panel today. It was a lot of fun. So yeah, if you have any questions for the Crypto CFOs team, you know how to get a hold of them. If you want to connect with Eric and Cameron, how can they best find you?
Yeah, you can be on Twitter or X, 0x CryptoTax, Telegram, Cameron_CPA, or at our firm website, www.darinadvisors.io.
Yeah, I appreciate it all the time, guys. This was amazing, and I will do it as often as you guys want. This is fun. It's www.verdacm.com, which is our main website. Eric Tomaszewski at verdacm.com. But it's probably easiest just to go to Twitter at digitized_Eric is me on X, and look forward to connecting with everybody.
Perfect. Well, I guess with that, we'll go ahead and close out this session. Thank you all for coming today. Hope you have a wonderful last day of the conference, and we'll see you all next time. Cheers.
Thanks, Rustin.